These are the top 5 holdings for Cathie Wood's ARK investment. She's the queen of disruption. Let's see what I think about these companies. First, company number 1, Coinbase. The chief legal counsel of Coinbase went to my high school about 15 years before me. Coinbase has an incredible run. Look at this. What is going on here? Why is the stock showing such a high number? The last 5 years, look at this. It hit a low of $31 per share back at the late 2022, early 2023. At the end of that bear market, the start of the new one, and now it's at $250 per share. What's the reason? A little thing called Bitcoin. Where Bitcoin goes, I'm sure Coinbase will go. It was very, very low. And the thing about ARK investing, though, that hit a high of $160 a share. It's now at $48 a share. Yesterday, Dalton, our in-house analyst, was at the airport. He overheard people talking about ARK investment and Cathie Wood and how she's on the forefront of disruption. Anyone who thinks that is stupid. She has no idea what she's talking about. And I'm going to show you why she doesn't understand investing. When she was criticized, when she was at the top of her game of 160, she criticized value investing and criticized Warren Buffett and Michael Burry. When her fund fell to $30, $35 a share, she was talking about how everything was deep value. So she criticizes value here, says it doesn't work, disruption's what works. And then when her disruptive plays fall like crazy, she says, no, wait a second, I'm just kidding. This is all deep value. She still has a really high, she has a base case, a bear market case of $1,500 a share on our next company. But for Coinbase, here's a couple of reasons why I don't like Coinbase. Annual revenue. It's going to go where Bitcoin goes. Look at this. 530 million, 1.3 billion, 7.8 billion, 3.19, 3.11. My guess is they're probably having record revenues by the quarter right now. I wonder if the quarter is not going to be done yet. But guys, they barely made money last year, $95 million. And worse yet, shares outstanding. Ready? 183, 186, 177, 222, 235. They're diluting people. The execs in the company are selling their shares the second they get the options. How do they really believe in the company? I don't really understand that. Stock number 2, Tesla. Like I was saying, guys, she has a base case of Tesla at $1,500 a share, which would be 8 times higher than where it's at today, 9 times higher, something like that. When it was at $414 a share, she was like, see, I was right. This is smart. Somebody on the internet was saying recently that she was right about Tesla. Guys, I don't know about that. Maybe she is. She probably still thinks it's a software business. You know my opinion on it. 85% of its revenue comes from cars. It's a car business, right? Until they're able to make high margin software sales that really drive the revenue and profit, it's still a car business. In all likelihood, I will be a billionaire someday just based on time. Do I call myself a billionaire today? No, I do not. That is ridiculous. There's a high school athlete out there who's going to go pro in some sport in 5 years. Does he call himself a pro athlete? No, he does not, right? Come on. Just because you can do something doesn't make you that something. Until they see the revenue coming in, they're not a tech company. Now, can you value the tech component and bring it to today's value? Sure. But what's that worth? I don't know. This is a car business selling for 5.6 times price to sales. Here's the interesting part about Tesla. Where's it gone? It is currently at 176. It was there 4 years ago. It's basically 3.5, 4 years of nothing. No growth. Now, is it still up a lot from 10 years ago? Absolutely. But remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. This company is worth a lot more money than it was 12 years ago, but I still think it's overvalued. I think Cathie Wood is going to end up, I say this in every Cathie Wood video, I think she's going to end up retiring at some point when the market really does have a bear market that wipes her investors out. And she's going to say, I'm going to concentrate on family and friends. And I can't wait for us to do a video someday taking a shot of every single time I said that and putting it in one video saying, I called it. Now, guys, when we talk about process, you're going to pick the process. You're going to use the fundamentals here. You're going to use the fundamentals in our stock analyzer tool to sit there and determine the right companies to buy at the right price. But when you see this happening, and you might sit there and say, well, Paul, you preach if a stock's going down to stay with it. I preach that if the fundamentals make sense. The fundamentals didn't make sense here on Tesla. I don't think that makes sense here on Tesla. Coinbase is basically just investing in Bitcoin and crypto. If you believe in it, sure, but you can't justify it based on today's money. I don't care what you say, unless you think Bitcoin, like Cathie Wood thinks Bitcoin's going to 3 million or something. Great, more power to her. Awesome. But there's no thesis behind that besides people are really going to like it. Okay, cool. How many .com companies went to zero back in 2000? Let me ask you a question. Is the internet bigger now than it was 25 years ago? Of course it is. It doesn't mean things have to work out to everybody's profit just because the industry gets bigger. And that's the hard part about investing. It's sitting there and separating the emotion and the story from the fundamentals. You have to be worked together, but you buy based on fundamentals and a story, but you hold it based on continued fundamentals and emotion. Because any investment you have will have pullbacks. Berkshire Hathaway has had 350% plus pullbacks in the last 50 years. That doesn't mean it's a bad company. It just means got a little too frothy and pulled back. But if you believe in the fundamentals, do you still hold on to it? That's what makes investing hard. Because when that stock is going down, you're going to be in your room going, what did I do? Did I make a mistake? But if you understand the fundamentals, you look at it as a buying opportunity. And that's exactly why I spent the money, the millions of dollars, creating all these tools and this community. The tools are used to make the right financial decisions, the right analysis. The community is where you go to have the like-minded people helping you out when things seem tough. And guys, there will be a time again when things seem tough. It's amazing that Morgan Housel says that everybody acts surprised when there's a bear market, but they all know a bear market's going to come at some point in the future. We all know it's going to happen, but then everybody acts surprised. What happened? Well, guys, if you're a good investor, you're going to keep your emotions in check because every great investor does that. So if you want to make less emotional decisions and probably make more money, sign up for our community. Click the link below, $7 for 7 days. We're going to start a wait list soon. So sign up before the wait list starts because we want to make sure we keep a limited number of people joining our community every single day. So sign up now before that wait list starts. Now, company number 3, Roku. Now, Roku is interesting. Why is Roku interesting? I actually kind of like Roku as a service, but I don't know how it's going to compete against Apple TV and these other ones. The revenue is growing somewhat. I mean, you have revenue growth. It's not huge, but the problem is this right here. Look at this profitability. Loss, 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 loss. Profit, loss, loss. It's just very, very difficult business. And guys, when a company has losses, there's only 2 ways to fund those losses. Taking on debt or issuing more equity. Let's go see through the point of shares. Ready? 10 years ago, 85 million shares outstanding. 5 years ago, 115 million shares outstanding. Now, 142. All you're getting is diluted along the way. Why? They have to pay for those losses. It's almost double the number of shares. It's like 60 or 70% more shares today than there were 10 years ago. So even though the business is better, you're now splitting up amongst a lot of people. And this is a very common theme amongst Cathie Wood's disruptive businesses. Why? Because they tend to lose money for long periods of time. I'm okay with that. But you've got to factor that in with your investment process. You got to sit there and say, when it finally does make it, I'm going to be diluted and diluted and diluted. That's the problem with it. That's what makes it hard. And I can assure you she doesn't understand that concept. Now, am I being mean? Perhaps. And I should tailor it back a little bit. She probably really does believe the bullshit she says out there, but she's a marketing person. She gets 75 basis points for every dollar invested. They have $7 billion invested. So what does that mean? She gets $50 million a year in fees. So she's making a lot of money by running that fund. More power to her. But she's absolutely blasphemous when it comes to money. She has no clue what's going on with investing. She talks about disruption. Oh boy, disruption. She says these value investors don't get it. But then when her stocks fall, she's like, oh, these are deep value. Come on, give me a break. Stock number 4, Block. This is a former Square, also making a bank on crypto. All-time high, $2.89 a share back in August of 2021. Currently at $78 a share. And guys, that's after being up 18% in the last year. And of that 18% last year, 15% was last month, 70% in the last 6 months alone. 70% growth in the last 6 months. That means this company right here was a $45 company. What was it? $38.85 back in October. $38. It's doubled since October 30th. Let's go look at the revenue. Now, guess what? Their Square service for credit cards is incredible. And look at this revenue growth. $850 million, 1.3, 1.7, 2.2, 3.3, 4.7, 9.5 during COVID. Doubled its business during COVID. 17.7, 17.5, 22. Big time growth. Now let's go see the profit here. All right. Loss, 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 profit, 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 loss, profit. And this profit here in the last year was basically a rounding error. $10 million on $23 billion in revenue. Come on. Let's go look at the shares outstanding. Spoiler alert. 284, 170, 340, 380, 405, 425, 443, 460, 578, 606. Oy vey. Guys, for companies like this, I just don't understand why people don't just wait. Wait for the company to prove its path out there. Wait for the company to realize this is how we're going to make money consistently. Yes, it's exciting to invest in all this disruption, but you know what's not exciting? This to me is not exciting. And this tends to happen very quickly with companies that don't make money. It's hard for a company that's profitable, has a good future, like Microsoft to fall, 60, 70, 70%? 80%, sorry, 80 or 90%. That wouldn't happen with Microsoft unless the entire market was down an insane amount. If Microsoft ever fell 90%, I'm gonna have to kidnap Nick and Tim over here and sell them because I'd just be like, I gotta buy more shares. That's an incredible business. That doesn't happen here look at Peloton, look at Tattooed Chef, look at all these disruptive Workhorse, Nikola, these companies that all fell 90 to 100% very quickly. When companies don't have fundamentals, they're gonna be very volatile. And it's fun when it's going up. It's not fun when it's falling. And all I'm trying to do is teach you that if you find a couple of good singles and doubles that let them compound over and over, you will make a lot more money than finding the next Tesla, finding the next Coinbase. Final company, UiPath. Ticker symbol, PATH. They're all about automation. Again, all-time high, $90, May of 2021. They're currently at $21 a share. $21 a share. They hit a low about a year ago of $12 a share. They're 20. Now look at this, guys. Free cash flow, $300 million last year. A loss of 32 is the average of the last 5 years. And losses here in net income. Guys, all of our businesses suck. I'm sorry. These are not businesses that people who understand business would invest in. Maybe Tesla, but even then, Tesla's probably got the best prospects for the future that you can determine. But even then, they're valuing it as a tech company. And I get it. People say that. And guess what? I used to say a lot of gibberish 25 years ago when I believed that every .com had a future. I would say whatever it took to sit there and justify it. At the end of the day, it still sells cars. So guys, again, if you want to take the emotion out of investing and stick to fundamentals and understand the story and make better decisions from that, click the link below, $7 for 7 days, join before the waitlist happens. And guys, if you want to see the 13 companies that I personally own that you can critique, watch our next video. Thank you for your time.